Hi, my name's Tim Smith. I'm the president of Fairway Asset Management. In this brief presentation, I'm going to explain how our Advance and Protect investment management process works. Advance and Protect is a capital preservation model with an offensive strategy. More simply put, that means we're going to try and capture growth when the market is rising and protect capital when the market is falling. We use a strict buy and sell discipline and a combination of qualitative and quantitative strategies to achieve our objective. Our qualitative strategy is a fundamental analysis that we use to filter all the available investments down to the ones we want in our portfolio. And our quantitative strategy is a computer program we use to determine entry and exit points. This diagram is a very simple way of illustrating the objectives of Advance and Protect. Of course, we can't guarantee the perfect entry or exit point, but in general, the objective of Advance and Protect is to participate in the market when it is advancing and move out of the market when it is falling. We are not trying to predict when an uptrend or downtrend is going to happen. Rather, we wait for an uptrend to start before going into advance mode, and we wait for an uptrend to end before going into protect mode. The basic concept of Advance and Protect is a defensive model with an offensive strategy. We use cash as a position to balance risk. So in an advancing market cycle, cash levels will decrease as the portfolio becomes more fully invested. In a declining market, we sell the investments and cash levels increase. Sometimes cash is a much better position to be in versus stocks. We start the process with our cash or equity positions. Then each quarter we run our fundamental filters to make sure we have the best holdings in the portfolio. The computer model then determines when to buy each holding and how much to buy using dynamic asset allocation. As the market cycle advances, the computer model will balance risk by trimming some positions and adding others. And then when the market cycle turns negative, the computer model will issue sell signals and we liquidate those positions and the process starts all over again. So why use Advance and Protect now? To answer this, let's first take a look at where the market has been. Over the past 60 years, there have been 4 distinct market eras or cycles. 2 of these cycles have been prolonged bull markets offering above average returns with very little volatility. The other 2 have been sideways markets in periods of high volatility, making it very difficult to create wealth. An active investment process like Advance and Protect may be useful in navigating these volatile periods. The first market era was after the end of World War II, when the S&P 500 experienced an 18-year bull market from 1949 to 1966, with an average annualized return of 14.6%. This was a period of booming economic growth and very low market volatility. Well, that cycle was followed by a 15-year sideways market from 1967 to 1981 with high volatility, a stagnant economy, and high inflation. During this period, the average annual return was just 7.1%, and as you can see from the chart, most of that return occurred in the later part of the cycle. Well, in 1981, Ronald Reagan lowered taxes, creating the catalyst for the best 18-year bull market in the S&P 500 history. The average annual return from 1982 to 1999 was 18.5%. As you can see from this chart, there was very little volatility, and the market basically went straight up. And then we have the last decade, which many people call the lost decade for stocks, with 2 large market declines and relatively flat total returns. If history is any indication of what lies ahead, we're likely to have 4 or 5 more years of this kind of up and down market volatility. During this kind of market cycle, active investment strategies like Advance and Protect are very important. So why use Advance and Protect now? In our current market environment and over the last 10 years, a buy and hold investment strategy has not worked. Investors lost a lot of money in the last 2 bear markets. As individuals, we don't have infinite time horizons, and it becomes harder and harder to recover from losses the older you get. Also, due to globalized markets and electronic 24-hour trading, diversification alone is not enough to reduce market risk. For example, in 2008, all asset classes fell in the same way, except for cash and treasury bonds. Diversification did not help reduce risk. The retail investment community has decided that modern portfolio theory is the best way to control risk. Developed in 1952 by Harry Markowitz, the modern portfolio theory basically says that you control the risk of the portfolio through asset allocation. You match the asset allocation of stocks, bonds, and cash to a person's risk profile, and then you keep that allocation intact at all times. You rebalance periodically and do not try to time the market, because missing the best days in the market cycle can reduce performance. Advance and Protect is a more dynamic process. We are not going to sit in one of these allocation models all the time, but we will move up and down the risk spectrum based on market conditions. So when the market is advancing, we will reduce cash and be more fully invested. When the market is falling, we will increase cash levels and become more conservative. This is a comparison of buy and hold versus advance and protect using an article written in 2005 for the Financial Planning Association Journal. The article was written in support of a buy and hold strategy, and the author looked at a 15-year period from January 1984 through December 1998. The S&P average annual return during those 15 years was 17.89%, but only a handful of trading days accounted for most of the S&P 500 returns. According to the article, if you missed the best 10 trading days in that 15-year period, the S&P 500 returns were 14.24%. If you missed the best 20 days, the returns were 11.99%. If you missed the best 30 days, the returns went down to 10.01%. And if you missed the best 40 trading days over that 15-year period, the returns fell to 8.23%, less than half of the 17.89% annual average. What the article doesn't say is what happens to returns if you miss the worst trading days. So we looked at the same time period the article looked at, and missing the worst trading days during those 15 years actually had a much bigger impact on returns. If you missed the worst 10 days, the returns were 24.17%, not 17.89. If you missed the worst 20 days, the returns were 27.04%, and missing the worst 30 days, the returns were 29.45%. And if you missed the worst 40 days out of the 15 years, the returns were 31.66%, almost double the annual average return of 17.89%. Now this is for illustration purposes only, and we cannot time the market perfectly to capture those best days and miss the worst. Doing that is impossible. So what we did is eliminate the best and the worst trading days from the same 15-year time period. It was interesting, missing the best and worst trading days still beat the buy and hold return of 17.89%, and the returns were pretty even regardless of whether it was 10 or 40 days. That's basically what Advance and Protect does. It removes the peaks and the valleys from a market cycle and captures the middle part of the return. This was meant to be a very quick overview of our Advance and Protect strategy. Many people have the Advance part built into their buy and hold strategy, but what they're missing is the Protect strategy. We think our strategy is well suited for not only up markets, but for both sideways markets and down markets as well. If you'd like to learn more about our process and how it could help you, please email me at tsmith@fairwayam.com. Thanks for taking the time to watch us. Have a great day.